about this particular matter. And Isaah, thanks so much and welcome to Morning Live. So what is exactly happening with the rand? Why is it so volatile at the moment?
Thanks. I think if you look at what happened last week, there are two aspects to the weakening currency that we saw. Firstly, is the trade tensions between Turkey and the U.S. That impacts us through contagion because you know we are grouped together with other emerging markets. So every time there is a sell-off in emerging markets, we tend to sell off as well. If you look at the correlation between the dollar rand and emerging market index, it's close to 1, which means every time we have an emerging market sell-off, the currency is going to be hammered as well. But also we had some local aspects to the weakening dollar rand that we also factor in. You know, there is a lot of uneasiness with the ruling party's decision to amend the constitution to allow for land expropriation without compensation. So there's a bit of politics or political risk premium in the weakness that we saw. So those two factors are by and large the primary drivers of the recent weakness. But the bigger one of them is really the global factors, which accounts for 60% of the dollar rand movements, which is the global factors associated with the Turkey sell-off.
So why does the effect on Turkey matter to us, Isaah?
It matters quite a lot because foreign investors usually they buy into emerging market index. So they don't just buy South Africa alone. They buy a basket of currencies, which includes South Africa, Turkey, Argentina, Brazil, which are your big emerging market currencies. So when you see the sell-off that happens in Turkey, it implies that that index, which foreign investors buy, they would normally sell it in order to reduce the risk of exposure to Turkey assets. So by consequence, because we are part of that index, we also get sold off.
And what about internal factors? What are some of those forces at play?
I think if you look over the past 6 months, first quarter growth was negative, it contracted. Second quarter also is looking as if it's going to contract. If you look at monthly data of mining and manufacturing, retail sales have been particularly weak. We didn't see the rebound that we usually see in the second quarter. So in part, it's because our economic growth is very weak, but also the political factors surrounding the amendment of the constitution and also news of very weak state-owned companies' balance sheets plays into that weakness in the currency. And combined, those factors, those domestic factors, they constitute about 40% of the currency weakness. But this particular one is more driven by external factors rather than internal factors.
And Isaah, I guess the million-dollar question is, how will this affect consumers, you and I, if this run actually continues?
If it continues and if the oil price remains above 70, we are likely to see continued increase in petrol price. That's the first impact. The second impact is the impact of increasing inflation generally. As we move forward, we have seen inflation has ticked up since the low it reached in March earlier in the year of 3.8%. It's now about 4.6%. So we will expect this inflation to start increasing about 5% or even closer to 6% over the next 18 months or so if the currency remains very weak and oil price remain above 70. That is the second impact. But more generally, the cost of living is going to increase. Unemployment has increased, and with the prospect of employment generation very weak because of a weak economy, it implies that the consumer is going to be under pressure for some time to come. Of course, bearing any change in the global environment.
Well, thank you so much for that clarity, Isaah Mhlanga, who is the Executive Chief Economist at Alexander Forbes. And